This is TreppWire Week in Review for week ending January 14th, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance, and Lonnie Henry, Head of Advisory Services. This week, President Biden announced more COVID tests and military medical teams for hospitals as COVID surges break records. And with Fed nominees Powell and Brainerd appearing in Senate confirmation hearings, investors were waiting to hear how last month's inflation numbers played out. Consumer inflation rose to its highest level in 40 years, but wholesale prices rose less than expected. Initial jobless claims were higher, but on the heels of December's unemployment rate of 3.9%. Manus, the markets did react later today. What was the chief catalyst?
It's hard to say a little bit because the only piece of news that came out during the day was the Supreme Court striking down the private business mandate for vaccinations. It struck that down by a 6-3 vote, although it did uphold mandates for healthcare workers by a 5-4 vote. But that's not a really shocking outcome. I think people were kind of tilting towards this is a possibility. And I'm not sure how that would have moved the markets over the course of the day. On Thursday, interest rates were falling. So it wasn't like the 2.5% drop in the NASDAQ on Thursday was a function of rates continuing to spiral higher. So it was really a quite inexplicable and sloppy trading day on Thursday. But we'll try to go through these things one by one, and I'll let Joe and Lonnie react. Going back to last Friday morning, a really dismal jobs report in the headline number. And this is kind of a theme that was all throughout the week. The headline numbers almost completely were negative, but when you scratch beneath the surface, they weren't quite as negative as the headline number would have suggested. So in the case of jobs, just under 200,000 jobs added. That was less than half of what expectations were. So if all you do is read your local tabloids, headline page or, the snippet in the business segment, you think that's a disaster. But at the same time, October and November jobs numbers were revised upwards substantially. So a little bit of yin and yang there. On Tuesday, I guess it was Tuesday, Wednesday, when CPI came out, that headline number again for casual market watchers, 7% year over year. That's a really startling number, but it was pretty close to what those that are really on top of these numbers were anticipating. And then today, Thursday, we saw two things, higher than expected initial jobless claims and that really screaming headline of the 9.7% PPI. But again, there, it was largely in line with expectations. So the immediate reaction after all these things was not the sometimes reaction you see from the markets, which is an immediate race for the exits. You didn't see the market spiral lower. You didn't see panic. You didn't see a race for safety. Whenever that came, it didn't come until about 2 o'clock today when we saw the NASDAQ really sell off considerably, down 2.5% today. And Treasury yields start to come down considerably.
Yeah, I think it's interesting. You look at all of this, together. We like to call it scientific Texas term. We call a hodgepodge. Maybe not that scientific, but as you go through these individually, Manus, you could see some rays of hope, and you could see some things that maybe you're a head scratcher. I think the labor market, the takeaway there is it's still a very tight labor market. Everywhere you look, there's people resigning. People having jobs posted, hard to find good talent, labor costs are up. I think that's being, shown here. I think what's interesting is a lot of people front run these stories now. So these headlines don't maybe move the markets in real time like they used to. And it's because people have some expectation of what the results are going to be before they're even published. So I think we're actually seeing that play out in this example this week, where some of these things on their face may have been, needle movers, but if you have a pretty good idea what it's going to report at and it comes in a little bit higher or a little bit lower, it's not enough to really rock the boat.
One data point I saw today, which was kind of off the beaten path, something you don't see that often, But was meaningful to me was one of the business segments this morning had statistics on the percentage of students showing up for school over the last week or two with Omicron growing. And we did see some numbers on there, largely in the South, where the number was 90% plus of the students that were showing up. But if I remember correctly, when they showed Boston, New York, Chicago, and San Francisco, and I'm going a little bit off the top of my head here, the numbers were between 70 and 75%. And part of that, of course, is, people are getting coronavirus, right? Even kids are getting it from time to time, which is keeping the numbers down. But the other is, an element of fear that the kids will get it, people keeping their kids at home. And this is not any kind of moral judgment or anything like that. It's more me saying that any kind of release on the wage pressure and the tightness of the job market is not anywhere close to being right here. If 1/4 of all parents are compelled or need to keep their kids home from school right now, that's 25% of people that might otherwise be going to work or finding new jobs or re-entering the workforce. And that will keep a lid or a cap on the safety valve or, the pressure valve that could take some of this off.
Well, as I was watching the markets the last couple of days, there was a part of me that was the optimistic side of me was saying, ooh, like buying opportunity for Apple or Amazon or some of these like stocks that shouldn't be going anywhere anytime soon. But I also liked seeing some of the more level-headed folks on the internet pointing out like, oh, geez, stocks are down, 3.5% in the last 2 days, and then zoom out like 1% below all-time highs. You know what I mean? So I think there's some health to be had in this kind of a little bit of a shakeout, a little bit of a sell-off, especially in the super expensive names. In terms of the school thing, I can tell you that my 3-year-old son has been back in daycare the last couple of days after being out for a couple of weeks. First it was Christmas break, and then there was a COVID thing, so they had to stay out for a week and all this other stuff. And I would risk a lot of illnesses myself to get him in school 5 days a week. I can tell you that much. And if you didn't see it, Manus, it's worth looking at the 60 Minutes from this past Sunday. They did a whole segment on the labor market, and they happened to pick Greenville, South Carolina as a place to zoom in on, as a place where a lot of people have moved to during this time. And one of the key takeaways that I found, which was kind of obvious when they said it, but I didn't really thought about it, we've been having job growth for the last, year and a half or 2 years, ever since the huge drop. We're not back to where we were. There are still a couple million people who were working before who aren't. So I think that it's just a little confusing, I guess, right? Because there's so many job openings and there are so many people who were working before. So there's some sort of misalignment in terms of what the jobs are, how much they're paying, where they are, the flexibility or the non-flexibility or whatever, that, it's going to take a while for the economy to kind of figure that out.
I'll leave my last data point on a positive one. And that is, for those that are worried about kind of panic and 1970s like inflation and so forth, in the immediate aftermath of CPI coming out, the 10-year Treasury hit 1.81%. And that's up from about 1.5% maybe 3 or 4 weeks ago. But in the couple of days since then, we've seen the 10-year go from 181 to about 170. So even though these two data points, CPI and PPI, were alarming in their headline numbers, the reaction from the market wasn't one which drove long-term interest rates substantially higher. And what it tells you, it could tell you one of two things. It could be an extraordinary level of complacency, which is one possibility. But the other is that people do think that eventually the Fed gets this inflation thing under control, pushes prices back down, and there's no need for the markets to start seeing 2 and 3 and 4% 10-year treasuries at this point. It's at least that's the way people who actually invest in these things are thinking about it right now.
Yeah, I saw some tweets from Zero Hedge saying that there were some massive investment grade corporate bond pricings in the first couple of weeks of the year And when those corporate bonds are issued, a lot of times the issuers will buy a rate lock, and that will end up actually moving the market in treasuries, in 10-year treasuries. So I don't know this market well enough to say if that's right or not, but it's just interesting that it's not just one thing that's moving these things. There's actual kind of plumbing that's going on in the background that's also moving them.
Yeah, for the casual listener, I think, if you're talking about when is it time to start panicking, perhaps, it's when you start seeing that 10-year treasury moving up 10, 12, 14 basis points a day, day after day, day after day, getting into that mid 2 levels right now. Right now, that is not the consensus thought at this point, at least from the people that put large amounts of money to work.
For the last few days, a number of us have been in not so sunny Miami at the CREFC conference, but luckily it was a lot warmer there than it was here. And it gives us an opportunity to talk to clients and other industry influencers. Manus, you've commented in TreppWire that in talking to those folks, the prevailing sentiment for 2022 is that this year is going to look a lot like 2021. But you say not quite so fast. There's some similarities with 2022 and what's happened leading up to it that remind you of 2005. So the question is, how likely is that to happen? And I suspect we're going to have a little point counterpoint on this topic.
Yeah, thanks, Martha. I think that, I'll start by saying a tip of the hat to CREFC for pulling this off. It was a little bit disappointing, not disappointing. Obviously, everybody has their own risk profiles and so forth, and I'm not judging people who chose not to come. It was disappointing that I couldn't catch up with all 2,000 of my friends in the market like I wanted to. I was able to catch up with about 400 of my friends, and kudos to those 400 people that made it there and put on a brave face and, had cocktails together and went to the beach and hung out under the tent. It was
I heard Lottie was doing yoga, sunrise yoga. Is that right?
No sunrise boot camp for me. I'm not a morning person to begin with. If I'm going to work out, it's going to be late afternoon. Once my body is fully acclimated to all my muscles stretching out over the course of the day. I just thought
seeing you attempting to stretch your hamstrings, which is essentially bending at about 3-degree angle on the beach, would have been real great entertainment for our podcast listeners.
For those, nobody would really know this, certainly from the podcast. Even people who met me in person wouldn't necessarily know this, but I have a tough time touching my shins. I always have, even when I was 18. And I ran a lot in school. I played basketball, and I wasn't a sedentary guy, but getting the tips of my fingers below my shins was almost impossible, and it remains that way. So I'm probably the least flexible guy out there, but I love the fact that 400 of us got together and broke bread and everything else that came with it. And that was terrific. So going back to, the tenor of the conference, I always get a little bit nervous when everybody is on the same side of the argument. And I hinted at that before with the Treasury thing. I hopefully that this, range-bound Treasury level isn't a function of complacency, but kind of to a panel, everything was 2022 will look a lot like 2021, more robust growth in CRE, CLO lending, continued rebound in distressed assets of all kinds, including malls, really competitive bids from lenders. The market is awash in capital, really no hint of any bumps in the road. And when I went back to my room and I put my hands behind my head and I started laying in the bed and staring at the ceiling like I do every day between, Wheel of Fortune and Jeopardy, I started thinking how much it reminded me of the conferences in 2004 and 5, right? We came back from those conferences with a really, really deeply ingrained risk-on attitude. The market was buoyant. People were putting money to work. The market was growing. Values were starting to move up. We weren't at the top of Everest, but we were at base camp, right? We were moving up at that point. So in 2005, here were 3 things that were similar to 2021. Number one is we saw really the beginning of really robust growth in derivative lending. What does that mean? So the markets in 2005 started to see really an uptick in CRE CDOs, as they were called back then, which is always more speculative, right? Transitional properties, lower debt service coverage ratios, lower occupancies, higher leverage. So in 2005, we weren't where we would become in 2007. We weren't at 98 LTVs with all kinds of mezz notes and B notes and mezz debt, et cetera. But we were at kind of base camp there. 2021 was kind of the same thing, right? With 45 or 50 billion in CRE CLOs. In 2005, we saw the start of real risk premium compression, right? Triple B spreads starting to come down. They wouldn't be at 75 basis points or 65 basis points, which is where they got in 2007, but they were on this tightening trajectory, which would eventually end badly. You know, in the CMBS market, where we are now is we're seeing compression, not necessarily in spreads so much, but in cap rates for properties that are really sought after, multifamily, industrial, and so forth. And in 2005, we started to see an uptick in values, which kind of goes hand in hand with compression of cap rates, right? What we've seen over the last couple months is multifamily properties, industrials going for 50, 75%, 100% over where they traded for in 2015 or 2017. So does that mean 2022 turns into making 2024 look like 2007? I think time will tell. I don't know. I just wanted to point out two things. One, that I go to bed right after Wheel of Fortune most nights. And the other is that, you know, sometimes these things look very similar. And when they do, it's time to just kind of take a step back and assess where we are in the market.
Yeah, I think those are all valid points. And I would echo the sentiment from the panels, at least, Manus, in terms of the takeaways from this week's conference. And to answer Joe's question, I was not on the beach doing yoga, but I do think I might have pulled a hamstring walking out to the sandy beach tent that we actually had cocktails in. So there's nothing a little more awkward than seeing, 300 guys in blue suits and really expensive dress shoes walking across the beach to get to the free drinks that they're offering at the conference. So we navigated that and had a good time. And I echo Manus's sentiments on the conference. Even though the attendance was down significantly, it was good to see a conference of that scale still, persevere and prevail over a few days and have, some good content and discussions around the market. As for my counterpoints here, Manus, in terms of the takeaways and the similarities from 2022 relative to 2005, I would say there's a couple of things that I think still make the market viable. One, I think the major undertaking that we started seeing in 2005 leading up to 2007 was the invention and utility of pro forma underwriting, which we haven't seen in the marketplace yet. So underwriting standards have remained relatively stable. You're seeing actual deals get done with current contract rents or with lease averages looking at steps over the term and backing into a reasonable number for underwriting purposes. So there's no pro forma underwriting that's being utilized to get to unrealistic values. You hit a little bit on the loan to value. I mean, I think the LTVs on the whole are much more reasonable, relatively speaking. I think everything, if you look at the entire, securitized space, the average LTV is still sub 70, probably somewhere around 68%. So I think there's a lot of downside risk for the lender that's been accounted for with those low LTVs. So they're not really exposed like they were in 2005 leading up to 2007. And then while the appraisal values are higher, they are supported by actual sales transactions in the marketplace. So as you mentioned, sales prices, when looking at 2015 to now, on a per square foot basis or per unit basis are significantly higher. Those are actual transactions that have taken place in the market. So somebody has been able to raise the capital and get a deal done at those prices. So it's not, again, pro forma or kind of, ghost pricing in the market. Those are actual transactions that are supporting those higher appraised values. So I think, overall, there's a lot less concentration as well. So if you look at the property sectors that have seen those uptick in prices and uptick in appraised values, you're looking at multifamily, which we would all agree has been very stable. And, the outlook for that, I think, remains stable. There's not been enough housing built. You have a lot of tailwinds on multifamily even into the next few years. I think the other thing, you look at industrial, it's got 20 years where it was kind of a B-class asset relative to the other asset classes. So you've seen a lot of run up in pricing and stuff with industrial, but with COVID, the market has shifted to a more logistics-based industrial type of play. So I think that we're not seeing office buildings or speculative investments or their ground up developments trading for, increased pricing. These are assets that appear, the fundamentals appear to be stable. Although I will contradict myself a little bit here. I was listening to a Barry Sternlicht report the other day. He actually had a comment that said there's so much capital on the sidelines that capital flows can overtake fundamentals. And that kind of hit me. I think some of this, if I were to align with your initial points, sometimes that excess capital on the sidelines can overtake the underlying fundamentals. So I think we have to be cognizant of that. And then last thing, I think interest rate environment's completely different here. Interest rates are at all-time lows. And so that leads to a compressed cap rate market and environment. So I think, if I'm looking at 22, I think we're still in smooth sailing. If interest rates start to rise, if some of that capital does start to impact the market more broadly, where it overpowers the fundamentals, then potentially, we're setting ourselves up for a 2005-ish, but I would say that's probably 18 to 24 months ahead of us.
Yeah, I agree. Excess capital is often the source of bad decision-making ultimately, and that's quite possible. I take that very seriously. I think that's a risk. I should point out a couple of things. First is I put this out via the TreppWire. I think it was Tuesday morning or Wednesday morning, these thoughts. And what I would say is they were kind of observations, not convictions. I'm not totally convinced that 2021 is kind of base camp for making 2023 or 2024 2007. It was more kind of making the comparison. And I started the conversation off by saying that there's nobody on the other side of the coin. I should amend that. One of our readers tipped us off to the fact that Richard Hill's team at Morgan Stanley had put out something which was akin to kind of what we're saying, that, we're starting to see the beginning of froth. I haven't seen the Morgan Stanley piece yet, but I'm going to go out and find it and take a look of that. So Morgan Stanley could be playing the role of what Tad Phillip did at Moody's 15 years ago, which was to kind of be the early warning sign or the guy saying things are getting crazy here. But I'll try to dig up that Morgan Stanley piece and give it a read before next week.
My father-in-law played golf with Tad Phillip just randomly. And somehow, I guess they started talking about what they did. And Tad said he's retired. I used to work at Moody's. My father-in-law said, "You ever heard of Trepp?" He's like, "Of course I've heard of Trepp." Like the one guy in like Westchester that would have actually heard of Trepp. He actually ended up playing with. Anyway, I would say flows over pros is like a real big deal. Like that's not my term. That's somebody's term in the interwebs. And it happens in the stock market as well, right? There's just so much capital flowing into 401k plans and IRAs and investment accounts and ETFs and Vanguard and everything else. Just kind of like that inexorable inflow into the market. I will say, if you look back at the Fed funds rates, you see from 04 to 07, they were getting stepwise increased, right? So I think in order for this to have some sort of similar replay, you'd see that, right? And I just don't believe that the Federal Reserve has the heart or some other body part to continue to raise interest rates if the markets puke on it, right? So I just think that we're in for a long-term period where interest rates are just going to be low for a very long time. And the only thing that I think slows us down is if the Fed actually decides to let its balance sheet truly run off and soaks up that several $1 trillion that they had printed in the last year and a half. Because without that, I think the canary in the coal mine should be like NFTs and cryptocurrency. Like when you squeeze silly putty in your hands and it like comes out through your fingers, like the NFTs are the thing are that, right? Like the cash is just going everywhere that they had to find a new place to put it, which doesn't even exist. So anyway, the point is that goes first, and then, we'll start to see some other real asset changes. But then again, who am I to say? In 2005, I was a junior in high school. So I don't know anything about anything.
You were just stealing music off the internet, right?
Yeah,
Well,
I
it
was
was still
just
Allegedly. Well, time will tell. But if our listeners have any thoughts on which side you think is the right side, let us know. Send us an email. Moving on, we had a couple of unpleasant surprises in New York hotel valuation and in California on office and retail.
Yes, I think that for the most part, I've been, talking about the glass being half full for a considerable period of time. We've seen tons of hotel cures, loans that had been delinquent for 12 months or more becoming current, loans that were distressed coming back and getting paid off, or REO properties being resolved with smaller losses than were anticipated. Delinquencies just kind of spiraling lower and lower all the time. So generally speaking, I think the narrative in CRE has been very good. But we saw a couple of reminders this week that even though things look pretty positive right now, there will be these stories that come out that remind us that we're not out of the woods, and there will be stories that in the future aggravate us or cause us to lose money or remind us that we're not done with some of the pain that we will see. So I'll run through some of these quickly, and Lonnie will give us a little bit more color, and so will Joe. The first one, we saw that the Empire Hotel and retail property saw its value severely reduced this month, according to January servicer data. The loan that is backed by that collateral is about 170 million. The collateral itself is a 423 room full service hotel in New York. The collateral was valued at 393 million in 2012. This month, the value was lowered to 137 million. The note's been in special servicing for a long time and has been delinquent for a long time. It makes up big portions of two 2013 deals. In one deal, it's almost 16% of the deal. The interesting thing for us, well, we saw the value reduction. That means that, a loss could be forthcoming on those two deals. That's certainly possible. But the other part of that particular story was that new special servicer comments revealed that the borrower and the special servicer had agreed in principle to a modification. So this is something that if you're trading those bonds, not only do you have to account for lower credit subordination going forward with the lower value of the property, but you also have to handicap the possibility that these loans get meaningful extensions and what that does to your IO flows or your early AAA repayments or your sub-investment grade repayments. So a lot going on there, and we'll continue to see that throughout 2022, distressed properties being revalued. Another thing we saw this week was a property in California that was sold, pay off a loan at par. This is another kind of disappointment. The story here is the $38 million 360 North Rodeo Drive loan was permitted to pay off at par this month. It represented a discounted payoff. This is the kind of outcome that hurts interest-only buyers and early pay AAA tranche holders that are carrying their bonds at premium prices. The collateral is about 7,000 square feet of retail space next to the Lux Rodeo Drive Hotel, which was sold last month. The property backs a deal that is part of CMBX 11. And so, here you have a situation where the loan is paid off 6 years early and takes some money out of the pocket of interest-only holders. It's not the last one we'll see. And lastly, to kind of go through a different version of potential pain, the state of California touted the fact that it had successfully reduced its office space by more than 760,000 square feet. The state itself has 14 million in square feet of office space. So as a percentage, it's not very big, but it does show the start of a trend that I think we'll see in other states where telecommuting results in states trying to reduce their office footprints. And in a report that will go out Friday morning, which we're happy to share, if people ping Haley, we itemize 4 or 5 properties that have agencies where the state has said they're in the process of giving back space and so forth. I should point out that a lot of the state leases have termination options, which make these things not as steady as you would hope. Sometimes the lease goes out to 2032, but a termination option is in place for 2025.
Yeah, I think the Sacramento Bee story that you're referring to there is really interesting because, as you mentioned, Manus, a lot of these have long-term lease expiration dates, but a lot of them, not only do they have termination options, but they have funding out clauses too. So if those things are not approved in the state budget or in the local municipal budget, then they have the ability to terminate the contract basically when the funding no longer exists. And so what's interesting on these, government occupied facilities is a lot of times they require a substantial amount of tenant improvement for those buildings in order for the state to occupy them. So a lot of government, contractor tenants have lead requirements. So the building has to meet certain lead specifications in order for them to even be able to occupy the space. So if you're looking at a building that's, a little bit older in age, there's extensive amount of work that has to be done. As it pertains to California, we highlighted one of the buildings, the Ziggurat building, a fairly recent deal, 2021 deal. This property is backed by a $59.1 million loan. It was actually an acquisition. So an investment group came in and bought this building, primarily occupied by the state of California. They paid $90 million for it in August of 21. So I'm sure they're reading this story and they're a little bit nervous about that. At the time of purchase, it's about 7.2 million of the purchase price was allocated towards upfront reserves for those tenant improvement allowances we talked about. So in this particular instance, they're trying to bring the building to LEED Silver certification. And so there was a substantial amount of upfront reserves and then lease play that they had to put into practice in order for them to maintain the lease agreement. So the developer owner is still on the hook for making those changes, even when they're reading stories like this where there's maybe a little less certainty for the tenant to stay in place. And on this particular deal, there's actually a go dark trigger event if the tenant reduces their footprint. I believe it was by more than 25%. Then there were going to be additional restrictions on the property in terms of the tenant, reducing their space. And so, I think this is something we should look at. If you look at our database, the largest tenant that we track is government tenants, and that would span the GSA tenants, not just the state of California, but they have a very large footprint across the U.S. And it makes sense. I mean, generally speaking, they sign long-term leases. They pretty much always pay the rent. So from an owner's perspective, you love to have long-term government tenant leases in your building. But as some of these maybe start to reduce their footprints, I think there is some, wide-scale risk to some of these assets that have a large government footprint in them, which is something for us to keep an eye on going forward.
Turning to hotels, we have a couple of stories and not all of them positive.
The news out of the week was there were a lot of comps to come out, sales comps in markets that had really been hit hard during COVID in terms of hotel closings, distress, and so forth. The 2 of the 4 markets that we continue to harp on are New York and Chicago. Other markets we've talked about before are Houston and Portland as others that have had a lot of distress. But over the last week or so, we've seen 3 or 4 stories come out that gave us new comparables of the New York and Chicago hotel markets. I'll run through them. They're not particularly pleasant. If you were hoping that these would represent sales that were at comparable numbers to what we were seeing in 2015 or 17, you'll be disappointed. The first one, this is from Crane's New York Business, the 755 key DoubleTree at 569 Lex, that's in Midtown Manhattan, was sold for 146 million, which represents less than 200,000 per key. The buyer was Hawkins Way Capital. The seller was RLJ Lodging. The asset was sold for more than twice that in 2010. So while prices and cap rates on hotels have firmed up considerably, the takeaway from this is that there'll still be disappointments in some markets at the values that you see. Another one was the Reliance Industries Group acquired an additional stake in the New York City Mandarin Hotel the Mandarin Oriental Hotel. It values that property at $135 million. The property itself is at southwest corner of Central Park by Columbus Circle. For anybody that's run the New York City Marathon, that's where you enter the marathon for the last 400 yards or so. It's a great part of the city. The valuation now is about $550,000 per key. The asset was valued at $1.5 million per key in 2007. And of course, 2007 was the height of the valuation mania. But here you see something at 35% of what it was in 2007. And then lastly, I'll talk about the Chicago Hotel Audrey. That sold for $87,000 per key. The 216-room hotel sold for $18.8 million in cash. And the article, which was also the real deal, it said that there was another $6 million in FF&E reserves flushed out, which resulted in the final recovery being about $24 million, which represented about $111K per key. So a couple comps for people to look at as they're trying to re-underwrite their New York and Chicago hotel risk.
I think what's interesting here is you could look at this and say, we've talked a lot about the retail market and the retail apocalypse and a lot of, retail properties being overbuilt in certain markets. I think you could make the same case for hotel properties in certain markets. So I know if you walk through the streets of New York or you drive through somewhere in Atlanta, there's a lot of hotels that I'm driving by saying, I don't want to stay there. And I think we're actually starting to see that play out in the marketplace. So it'll be interesting to see on these, is this just a trimming of the fat and these maybe are going to be no longer viable and used for something else into the future? Or is this something more systemic, in those particular markets? I think these three examples are probably just ones that weren't able to keep up their PIP, requirements and just probably weren't able to perform relative to the other hotels in the market.
Yeah, we've mentioned before that Chicago and New York were both overbuilt ahead of the pandemic. So their outcomes may not necessarily reflect what you see in other major U.S. cities.
Yeah, I'll say that. We're about to move into the office sector or section of the podcast, but in these places where nobody's back in the office, or I should say 20 to 30% of people are back in the office, it's a lot different, right? How many of those hotel rooms would have been filled up with business travelers on any given day pre-pandemic? I don't know what the percentage is, but I'm sure it's double digits. And then when you have all of the attractions of New York City generally closed or under strict mandate, that's going to be tough on those types of hotels.
Well, you look at the New York City Mandarin, 113 million in revenue in 2019, down to 15 million in 2020. You couldn't have predicted that. Nobody. That's just an unheard of decline in revenue. Even with COVID, that's a significant decline.
So Joe, you mentioned office. We're going to pivot to office where there are more positive stories there.
Well, the theme here is the rich getting richer. And one of those rich getting richer stories is in Lonnie's old neighborhood of Austin, Texas.
Yeah, so Austin definitely on everyone's list. They're calling it Silicon Hills now. And I think the office market's the biggest beneficiary besides the single family residential market. They're actually tied together, and I'll explain that here in just a second. But Facebook, I guess now Meta, signed a huge lease in Austin, Texas. So there's a new spec project under development, West 6 in Guadalupe. Facebook leased 600,000 square foot. They basically took down half the building. This is a unique project. Half of the building is office, and the other half is comprised of 349 residential units that are for sale. So those occupy floors 34 through 66. Facebook took the entire office component. So 600,000 square foot. I did a little bit of digging. It was interesting. Over the last few months, just on the publicly announced lease deals that Facebook has signed, they took down a 719,000 square foot lease in California. They've had a 520,000 square foot lease in California, the 730,000 square foot lease in New York, and now you add this 600,000 square foot lease in Texas. They've signed leases on about 2.6 million in office space over the last few months, which is really interesting, given that they're making a push towards the metaverse. It's a little bit contradictory, but I think, to give some context in terms of how the rich get richer, if you look at Austin CBD market rents, you can go back to say 2015 and your triple net lease rate for CBD space was in the $20 a square foot range. You fast forward to now, and it didn't report what the lease rate was for Facebook, but I'm assuming based on the data we could pull, the all-in, grossed up rental rates about $80+ a square foot. So in CBD, based on our data, triple net base rents in the $40 to $55 square foot range, and their triple net expenses are somewhere between $25 and $30 a square foot. So if you compare that to any of the other major metropolitan cities, Austin probably ranks in the top 5 in the CBD as it pertains to rent per square foot for their office space on the Class A assets.
Lonnie, you're probably regretting, having sold that 400,000 square foot Class A asset that you had when you moved out of Austin.
Well, it's interesting because the Facebook spokesperson that was interviewed for one of the stories I read said in 2017, I think they had 7 employees in Austin. They're up to 2,000 employees now. And with this new 600,000 square foot lease they signed, they plan to add 400 additional employees for that building alone. So those folks have to live somewhere. So if you're a multifamily investor, this is music to your ears. If you're a single family property owner, likewise, this is just meaning your home has become more valuable overnight.
Being the village idiot on the podcast today, I'm going to throw this out there. When I see these stories, sometimes I just think like, what are they going to do? Like these 4,000 employees that Facebook is adding, or, in the last year or two, like, what are they actually doing? I mean, I don't get it. Like Instagram is Instagram, Facebook is Facebook. Like, are they all going to be building Oculus headsets or like, building digital real estate? Like, sometimes I wonder, some of these giant companies just grow their headcount just to grow their headcount, or maybe they're all going to be monitoring content. Who knows? But
I think it goes back to the capital. Excess capital makes for crazy decisions, right? And so right now they're making a long-term play, I think, on some of these buildings, because to your point, Joe, the numbers just don't work. Like they're not introducing new products and developments at a pace that would justify the need for all this square footage, especially when they're giving, their employees the ability to work from home into perpetuity if they elect to. So it's very interesting. I think, if you look at the stock prices on Facebook and you look at some of these other companies, Apple and others, they're definitely playing the long game. They have capital available. They obviously have longer term plans that we're not privy to, because on the surface, it doesn't make sense for them. I mean, I don't know how you absorb 2.6 million square feet in a matter of a few months and then adequately even just staff that with people in the buildings. It's a very interesting concept, but I think we'll look back in 5 years and probably think, man, they stole all of that office space, or I can't believe they got into those markets at that time, because the pricing and so much more in 5 years is going to be, probably significantly higher. Barriers to entry are going to be higher than what they are right now.
Lonnie, you mentioned Facebook and the work from home thing. I will say again, catching up on my 60-minute this weekend, they had the chief economist from LinkedIn. And she said that before the pandemic, now I'm not getting these exactly right, these numbers, but I'm very close. I know I'm very close. She said that 1 out of something like 65 job postings were for remote work. And she says now it's like 1 out of 7. So that is a massive, like ground shaking shift. So, we talk about office, we talk about the long-term slow leak of office and everything else, but that just struck me on Sunday night when I heard that. I said, like, all this stuff we're talking about is real. I still think that there's going to be tons of demand for office space, because there is something to be said for getting together and also inviting clients or prospects to your beautiful Class A LEED certified building and all that. But I just can't, like, if 1 out of 7 people are working from home, like, does that mean that, we should go down in terms of occupancy by 1/7? I would think so, back of the envelope. So anyway, that's I'm probably completely wrong, but that's where I'm going to see that slow leak.
Moving on to shout outs. We have a bunch. We met a few folks at CREFC that were very kind. Janie L. enjoys the pod, but admitted that she can't tell whether Joe or Manus is speaking. So I'm not sure it mattered really, but apparently your voices are very similar.
I'm the one that sounds like this.
And Dan M., who's a big fan of the pod, we did have a few cocktails by the beach and by the band and by the buffet. So spent a lot of time with him. John D said someone on his staff listened to every single one of the pods, one after the other, as I guess, a requirement for the job. I'm not sure. Education sounds like
Apologies.
torture. Yeah,
I think we
exactly.
need to find out who that is and send them a TreppWire Podcast T-shirt. I think that's worthy of a T-shirt.
Yeah. And Todd O requested a copy of Lonnie's recent report. We had a bunch of tweets about our CEO Anne Marie's conversation with Derek Jeter, Michael MBA, Joe D, known as the Yankee Clipper, Haley C. Peter B gave us a shout out. Kieran R wanted to know what other conferences we'll be attending. And given some folks a full circle, Steve C thanked Manus for his shout out in last week's episode. Key Lime Johnny didn't know that Manus had a dog and pictured you more as a cat fella. I'm not sure if that was a compliment or not. I'll leave that to interpretation.
Well, Buccaneer John is he's always one with those biting remarks. So I'm going to assume that it was meant to tweak me.
Yeah, maybe. Mike
So I
B.
just wanted to mention that in terms of John G, we have an opening for the head of ESG at Trepp, which is a pretty exciting position. And I texted John and I said he should apply, since it's all about hot air.
Oh, ouch. Ouch. So Mike B promoted our portfolio lenders survey and other data that Lucius gave while we were down there. Dan McNamara and Phil H. And the last pod shout out goes to Joe McBride, who is someone who will be moving on to new things. We've worked together for 10 years, and I can say both professionally and personally, you're a good egg.
Well, thank you, Martha. I will turn off my camera now like Manus does when he sometimes gets verklempt and he wants to talk about something. I've been at Trepp for 10 plus years, and I actually started in 2006 as a 16-year-old data monkey intern, where I learned how to use a DOS prompt and where Ken Chang and Julie Yu taught me how to use Excel, and Pinar and Kerry taught me how to do red to blacks on new issue CMBS deals. I didn't know what red to black meant at that time, but I was definitely comparing columns of data to each other a lot. I will say, there is a reason that people stay at Trepp for a really long time. All I can say is that I'm very grateful for everything that Trepp has given me and for the people that I've worked with. I can't name everybody, but those early people that helped me out a lot. And then Martha, the best boss ever, who, you taught me a lot of things. And obviously the hardest working man in show business, who is Manus, setting an example for the entire company. And, I'm going to a place called Bluma, but, Trepp is where I grew up. And I feel bad. It's almost like an Oscar speech. Like I want to mention everybody that I've ever worked with, but that's kind of the cool part about this is that, I've worked with everybody in the company. There are just a lot of really great, intelligent, hardworking people. And that's the reason that I've stuck around for so long. And now what I'm going to miss the most is this right here, our little podcast family. Hopefully you'll invite me back every now and then. And I'll definitely miss our listeners out there who were mostly positive, and even the ones that hated us, I'll even miss them. So I guess I'll leave it at that.
Well, Derek Jeter said this week that for successful organizations, you need everybody to come to work every day with extreme passion. And I'm not sure there are too many people that have worked at Trepp during my 30 plus years that brought more passion every day than you did, Joe. And there's also an expression that you can't teach old dogs new tricks. And with this podcast and everything you brought to it and insisting on excellence in what we tried to do every week, you certainly taught this old dog a couple of new tricks. And I'm really grateful for your time here and grateful for a chance to getting to know you and working together.
Joe, I've only worked with you for about 3 years, but I'll tell you, it takes about 10 seconds to realize that you're a next level thinker, and your friendship has meant a lot. And, you've allowed me to grow at Trepp. We're going to miss you around the office. I'm going to miss catching up on Friday afternoon, and definitely miss you on the podcast. And best of luck in your new endeavors. Keep working hard, and thank you for all that you've done for us. I think we've all been the benefactor of your hard work and your optimism and perseverance here at Trepp. So thank you.
All of the listeners out there are probably thinking like the guy that makes fart jokes, that's who they're talking about right now on the podcast. I will say I was in the office today picking up some things, and I left some little trinkets and little funny items on a lot of people's desks. So it's a reason to get back in the office, people, just to see if you got the cool Game of Thrones figurine or if you got the snow globe.
Well, I have a feeling it's not the last we've heard of you. So with that, we'll close. Thank you to our producer, Haley Keene. We'll be back next week with what's happened during the week and how it may be impacting you. If you have a question or a comment, send an email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening, and stay well.
All right.